Let's dive into a down-to-earth topic in this video. How to get rich with stock trading like Buffett. In this video, I want you to understand what success in stock trading really means, and you can also hear several wonderful business stories. Let's begin. There are only two paths to wealth in stock trading. One is through risk, and the other is through compounding. The risk involved is often too high for ordinary people, and compounding, well, we have specifically disenchanted it. There's no such thing as long-term index growth in the real world. The author of this book, The Psychology of Money, Housel, specializes in investments, so he might be more optimistic than me, but after listening to this lecture, you may not necessarily gain higher confidence. First, Buffett's Secret. Housel wrote this in 2019 when Buffett was 89 years old, with a net worth of an incredible $84.5 billion. But if you understand the field, Buffett's investment performance is even more incredible. Throughout Buffett's investment career, his average annual asset growth rate was 22%. This is a miraculous achievement. No financial product dares to promise you a 22% return. By current industry standards, anyone claiming 10% is likely a fraud. Buffett's greatness doesn't just lie in stock picking. Don't forget, he can control. He can directly influence the companies he invests in, fully utilizing his abilities. You can't do these things, so don't expect returns at the 22% level. Now, let's do a thought experiment. Suppose, at the age of 30, you suddenly acquire Buffett's investment ability. From then on, your assets grow by 22% annually. Let's assume you enter the market with $25,000. This amount isn't huge, but for a 30-year-old, it's not negligible. Your investment skills are top-notch, but making money isn't the only thing in life. So, you decide to retire at 60 and enjoy life. Sounds reasonable, right? So, how much money do you have by the time you retire? The answer is $11.9 million. This figure isn't too high. Not enough for a life of extravagance in the latter part. There are many people in the world with assets exceeding $10 million. This isn't a miracle. Then why does Buffett have so much money now? Because his true greatness isn't the ability to achieve a 22% annual growth in assets. Buffett didn't start investing at 30 and retire at 60. He began trading stocks at the age of 10 and has been at it until he's 90. It's not 30 years of work, it's 80 years. When Buffett was 30, his assets were only around $1 million, equivalent to about $9.3 million today. Among his $84.5 billion in assets, $84.2 billion was earned after the age of 50. Among these, $81.5 billion was earned after the age of 65. At 50, Buffett was just an ordinary wealthy person. At 65, the typical retirement age in the US, Buffett, with his wealth, wouldn't attract worldwide attention. Let's make another comparison. Buffett isn't the person with the highest investment return. The champion is widely known as Renaissance Technologies. From 1988 to the present, their average annual growth rate is 66%. This performance is beyond my comprehension. Nobody knows their algorithm. The founder of Renaissance Technologies is James Simons. So, how much money does Simons have now? He has about $21 billion in 2019, less than a quarter of Buffett's wealth. Why is he smarter than Buffett but has less money? Because Simons found that magical algorithm at the age of 50. So, is a return rate something reliable? Even Buffett's sustainable return rate isn't the key to his success. Buffett's real secret to success is that he kept living. Second, same origin of profit and loss. There was a particularly famous stock trader in the U.S. history named Jesse Livermore. Born in 1877, he already had assets equivalent to $100 million today at the age of 30. In 1929, at the age of 52, Livermore experienced the great stock market crash in the U.S. On October 29, bad news kept coming, and several senior stock traders committed suicide by jumping off buildings. Livermore's wife, mother, and children were extremely worried at home, hoping for his return, fearing that he might also jump off a building. Livermore did return. He told his wife that not only did he not lose money that day, but he also made money. Intuitively, he shorted the stock market that day. The money Livermore made that day was equivalent to $3 billion today. In one day, $3 billion. You might think, with so much money, he could retire for a lifetime. That's a commoner's mindset. If you have such a mindset, that's why you can't earn so much money. Livermore must have continued to take risks. Making $3 billion in a day, what kind of experience is that? We can only imagine. Your mental state would be completely different, and from then on, you wouldn't be the same person. In English, there's a term called swellhead, specifically describing a person in this state. It means your brain has swollen, you've become inflated. Livermore specialized in such adventurous large-scale moves. However, just 4 years later, by 1933, he went bankrupt and lost everything. After a few years of uninteresting life, he eventually committed suicide. What Livermore used was a stock trading method entirely different from Buffett's. Sometimes this method made money, and it could make a lot of money in the short term. Chinese stock investors have a saying, same origin of profit and loss, meaning making money and losing money essentially result from the same reason. A love for risk can make you earn money, but it can also make you lose money. This saying was true in Livermore's case. If Livermore's method is called quick money making, Buffett's method could perhaps only be called preserving money. These two methods are completely opposite. Making money relies on luck, optimism, and a willingness to take risks. Preserving money requires avoiding risks, extreme humility, and harboring fear. We know that Buffett's Berkshire Hathaway has two giants, one is Warren Buffett, and the other is Charlie Munger. But what you might not know is that 40 years ago, this company had three giants. At that time, they also had a partner named Garen. Originally, the three of them made investment decisions together and visited various companies together. So why was Garen no longer there later? In 1973 to 1974, the U.S. stock market experienced a severe decline. Garen borrowed money to speculate on stocks during this downturn using high leverage, but the stock market still plummeted by 70% within 2 years. Unable to repay the loans, he sold the Berkshire Hathaway stock to Buffett at $40 per share and exited the game. That stock is now $340,000 per share. Buffett commented on this. Charlie and we both knew from the start that we would definitely become extremely wealthy in the future. Because we knew that would happen for sure, so we weren't in a hurry at all. Rick was as smart as us, but he was in a hurry. Just that difference. Third, what Buffett doesn't do. So, learning from Buffett isn't just about learning what he does, but also learning what he doesn't do. Housel lists several things Buffett doesn't do. Buffett doesn't borrow on a large scale. Buffett has experienced 14 economic recessions, but not once did he panic and sell stocks. Buffett never tarnishes his business reputation. Buffett never adheres to a single strategy, worldview, or trend. He is always learning and doesn't stick to one path. Buffett doesn't rely on other people's money to run his company. Buffett hasn't overworked himself, hasn't resigned, and hasn't retired. In short, Buffett relies on persistence and learning, not luck. Luck is unreliable. Relying on luck might make you money for a while, but the same strategy can also make you lose money. Buffett repeatedly emphasizes the concept of margin of safety. His strategy requires you to hold some cash even in a bull market. While others are fully invested, getting a 9% return, your cash can only give you a 1% return. This feeling is uncomfortable, but you must endure this discomfort to ensure that during a bear market, you still have money in hand and don't have to be forced to sell stocks. This is also the concept of same origin of profit and loss. We've read before that compounding is like chicken soup. No one can guarantee a 15% return every year, so how did Buffett achieve an average 22% growth? Let's look at a more macroscopic data, maybe it will give you some insights. Graph below shows the per capita GDP of Americans from 1850 to 2010, adjusted for real growth in comparable prices. This line looks quite stable. Except for the Great Depression of the 1930s, it almost follows a logarithmic straight line. Just looking at this line, you might think, isn't this compounding? This investment seems good. Well, you're wrong. Behind this line are the following facts. During these 170 years, 99.9% of companies disappeared. The U.S. experienced 33 economic recessions, totaling 48 years during these 33 recessions. The U.S. stock market had 102 times when it fell more than 10% from the previous peak. There were 12 times the stock market fell more than 1/3. In 20 different years, the U.S. annual inflation rate exceeded 7%. The current economic status of the U.S. isn't stable or developed. It has gone through hardships. Looking from a distance seems calm, but in reality, each setback is thrilling. The curve of per capita GDP is smooth because it combines all the results of success and failure. There's a mathematical principle here. For this kind of exponential growth, where countless successes and failures are combined, the average of the market is always more powerful than most people. That's why you should invest in index funds. So, you say, I won't buy index funds. I want to beat the market like Buffett. I want to be outstanding. Then you must learn to face failure. Your fear of failure must be far greater than your desire for success. This means you have to be patient, just like Buffett. Housel says this principle must be paranoid and optimistic. For the short term, you must be paranoid to avoid danger, be very cautious, and be afraid like a paranoid person. But for the long term, you must be optimistic. You have to believe that you'll only be quite wealthy after 50, very wealthy after 65, and famous after 70 or 80. Because you have such goals, you can endure short-term paranoia. Be optimistic in the long term, pessimistic in the short term. It's like what the Chinese say, scorn the enemy strategically, but attach importance to the enemy tactically. But trading stocks is far less interesting than going to war. There are only two paths to making money in the stock market. One is relying on luck, and the other is relying on time. On luck is unreliable. Luck can make you earn a lot of money, but it can also make you lose a lot of money. So, you might think, can I first rely on luck to make a fortune and then rely on time to preserve this fortune? This is too idealistic. If you can really make a fortune relying on luck, you'll become inflated like Livermore. But is it worth relying on time to make money? Buffett and Munger aren't particularly interesting people. These two claim to love reading the most, but in reality, what they read most every day are the reports of various companies. If you have hundreds of billions of dollars to manage, or if you naturally love reading reports, maybe such a life is worth it. Otherwise, I think it's better to do something else.
If you feel there is value in this, please like, subscribe to this channel, and leave your thoughts or suggestions in the comments section. Let's grow together and read more good books.